Alright guys, welcome to part 2 of the stochastics lesson. Now let's do a little bit of recap. During an uptrend, because price has the tendency to produce overbought signals, and hence when stochastics give you an overbought signal, ignore it, okay? So you want to buy when stochastics goes to oversold, confirm it with candlestick confirmation, okay? And on a downtrend, you want to ignore oversold signals because when the sellers are in control, it tends to give you a lot of oversold signals. So when you see oversold signals in a downtrend, most of the time it just means that the bearish trend is getting stronger and stronger. But if you see oversold signal at the end of a downtrend, it might mean that the price is going to go back on an uptrend, okay? So oversold signal is only significant at the end of a downtrend. Overbought signal is only significant and worth taking note of when you see it at the end of the uptrend. And in the early stage of the trend and the middle of the trend, when you see overbought signals, ignore it. Don't go and sell, okay? And on a downtrend, you want to buy on overbought with confirmation using candlestick signals. Stochastic divergence principles you need to take note of. When you see a bullish divergence, price will reverse from a downtrend to uptrend. What is bullish divergence? It means that price is making lower lows, lower highs, but momentum indicator is making higher highs, higher lows. Then bearish divergence, it means that the price is going to reverse from an uptrend to a downtrend. What is bearish divergence? It means that price is making higher highs, higher lows, but momentum indicator, and in this case stochastics, is giving you lower lows and then lower highs. Basically, there's a conflict between the price and stochastics. So some principles you need to take note of. The ideal conditions for divergence is when bullish divergence occurs at more than 50% of the levels. Bearish divergence has to occur less than 50% of the levels. So what do I mean by this? When you see a bullish divergence, preferably you want it to go above the 50% level. Okay, so this is the 50 level, which is the middle line. Okay, this is the middle line. You want stochastics to give you higher lows that goes all the way above 50. Okay, so this makes it a strong bullish divergence. And then for bearish divergence, you want it to go all the way to below 50. Okay, this will make it a strong divergence. Does this mean that if it doesn't go below 50, then you should ignore it? No, what I'm saying is that this just makes it a stronger divergence. Okay, so for example, if a divergence occurs like this from the top and then goes all the way down until here, which is still above 50, it wouldn't be that strong. So this is also one of the ways that you can use to spot a false divergence. Okay, so two main functions of stochastics. First thing is it increases the probability of your trades. If you are just using candlestick pattern to trade, you would get a lot of false signals. Understand what I'm saying? Of course, there are some people who use naked charts. They just trade with candlestick patterns and just based on chart patterns and market structure. But personally, I would feel that it's better to add one more confirmation, because the thing is, price doesn't show you overbought and oversold levels. Okay, so you can see over here, I drew a resistance zone. Okay, and when the price hit resistance zone, stochastics give you an overbought signal, and when it hit it the second time again, stochastics also give you overbought signal. And one thing you need to take note of is that if stochastics reverses really quickly from the extreme level, it gives you a clue that the trend is going to end. Okay, but if it goes from the extreme level and then just goes down gradually, just like that, taking the stairs going down, then it also gives you a sign that the trend is not going to end just yet. Just wait a bit longer before the trend ends. Okay, but of course, don't just rely on this signal alone, because stochastics can also give you false signals. Okay, as I add more indicators, then we can see where we can potentially enter. Now you can see why I don't recommend you to buy when stochastics go to oversold, because you can see that in a downtrend over here, if you buy when stochastics go to oversold, it went out a little bit, but then it go on a sideways movement and then continues to go down, particularly over here. Okay, if you bought here, price ranges a little bit and then it continues to go down. Okay, so you don't want to keep on buying when stochastics gave you an oversold signal, because oversold signals in a downtrend just means that the bearish trend is getting stronger and stronger, especially when you see it at the middle of the trend. Okay, and especially when stochastics goes all the way down to almost the zero level. Okay, the fact that stochastics was able to go all the way down just probably tells you that the bearish trend is going to get stronger and stronger. Okay, same thing for overbought signals, massively overbought signals. So you can see that in this case, stochastics almost went to 100. If it goes to this kind of extreme levels, it probably means that the rally is going to continue stronger. Okay, don't go and sell, especially when you're only at the start of the trend. You see 50 just crossed above 100. This at the beginning of the trend. So if you sold over here, look at what price do. It ranges a bit, then it continues to go up. So you wouldn't want to do that and trade against the trend. Of course, once in a while you see overbought signals and then the price retrace a little bit, but you wouldn't know where the price is going to retrace to. Okay, you see overbought and then it retrace a little bit. You're still trading against the trend, which is very risky, so try not to do that. Now the thing is, stochastics can also be used to range trade. Okay, now in range trading we normally use support resistance. So in this case I drew a support over here, and what you can do is that when price approaches support and then you see an oversold signal, confirm this with candlestick pattern. So you can see a Morningstar pattern that's not super perfect, but this is a bullish candlestick signal. Okay, so what you can do is that you can make a trade over here, especially when price bounce off a very strong support, and then you can see a resistance level over here. Okay, and then when price tests this resistance for the second or third time, stochastics gave you an overbought signal. Okay, so this is also suitable for range trading if you're into that. But I would prefer to use this to trend trade. Okay, to trade the trend. So you can see a bullish trend over here, and what you want to do is to buy at a very cheap price, because as a buyer you don't want to buy when it's expensive, when it's at the top over here. Okay, these are bad points to buy at. What you want to do is you want to wait for a retracement just like this, and especially when it retraces to a support level, in this case the 100 SMA, like over here. And then don't just enter when it tests the support and when it retraces, because you gotta wait for candlestick confirmation. So for example, if you zoom in over here, so you can see over here there's 3 white soldiers, okay, which you probably have learned if you went through a lesson, and hence it's a good place to go in. Confirm this with stochastics, okay, which went to oversold. So in an uptrend, remember, we want to look for oversold signals, so you can make a buy over here. Right, put your stop slightly below 100 SMA, and then TP at the recent swing high, which is over here, and you get the good risk to reward ratio. Now of course, if you choose to apply this on a bigger time frame, you would harvest more pips, and then you would hold your trade longer for days and also for weeks, and sometimes more than 1 month. Like I said, this strategy can be used in all time frames, but personally I don't use the minute time frames because I find it's too noisy, so try not to apply this onto the small time frames. Anything lower than H1 is too small. Okay, and how about a sell trade? Basically it's the same thing. Okay, now you can see price came up here and then test this 100 SMA, and stochastics show you an overbought signal, and it come back down to neutral level. Percentage DSO cost below, percentage K, and also you have a bearish candlestick signal over here. Okay, and hence this is also a good sell trade to get into. If you cannot find a recent swing high, or if the risk to reward ratio is not that good, or if you want to hold your trade a bit longer, what you can do is that you can take profit when the stochastics goes to the other side. So in this case, you have a bullish trend. Let's say if you bought when the stochastics went to oversold, okay, and the price came down and test 100 SMA, and then you can hold your trade all the way up until this point where the stochastics give you an overbought signal, which is somewhere over here, which is also in line with the resistance over here, okay. But make sure that you only enter a trade when the risk to reward ratio is good. When the risk to reward ratio is not that ideal, try not to enter into the trade. To increase your probability, make sure that there's a confluence of the indicators. For example, you want the price to test not only 100 SMA but also a trend line, okay, or a support level. Okay, give you a couple more examples. And you realize one thing about oscillator is that it will tend to move in the same direction as the price. So when the price is moving down, you see oscillators going down. When the price is moving up, oscillator also moving up. Price going up, oscillators also going up. So the thing is, if you're in a buy trade over here, for example, and you want to hold the trade up to a point, even though stochastics might not give you an oversold signal, you want to at least make sure that your stochastics is sloping upwards, because when it's sloping upwards, it means that there's bullish momentum. Understand what I'm saying? So this is also one way that you can use stochastics to increase your probability of your trades. Okay, just now I mentioned something about confluence. So this is what I mean. You see a trend line over here, and then you see your 100 SMA, okay, and then you see a resistance zone that I drew. So this is a triple confluence. So this is a triple resistance, okay. So it's like having 3 layers of ceiling, which makes it a lot stronger as compared to 1 layer of ceiling, okay. So for example, price came out here and then gave you a bearish signal. So in this case, you have a bearish signal over here. You can say that this is an evening star, which of course again is not super perfect, but it is a bearish signal. So you can enter in this trade, put your stop above 100 SMA, and you can also see that stochastics give you overbought signals, which is good. And you can put your TP at a recent swing high, okay, which is up until this point. But if you want to hold your trade a bit longer, then you can wait for stochastics to go to oversold, which is almost at the same point where you TP'd over here, okay. So this is what I mean by a good trade to get into. Now one thing you need to take note of is that you see an uptrend over here. When the price goes through a range in an uptrend, then suddenly it goes to overbought, okay. This increases the chances that the bullish trend is going to get stronger and stronger, because when the price breaks above a range, it is a breakout in itself, and a breakout on an uptrend both increases the chances that the price is going to continue to go up. So when you see stochastics go up to an overbought level after a consolidation, it doesn't mean that the price is going to U-turn and go back down. It means that the price is going to continue on a strong rally. And one thing you need to take note of is that when percentage K tries to cross below percentage D but then failed, when it comes very near together and then it tried to cross over but then it failed, this is also another indication that price is going to continue to go up from this point onwards. You can see from this point onwards, price rally a little bit, then blocked by this resistance. That's why it bounced down. So you can see one more over here. Percentage K tried to cross below percentage D, but then it failed. It kind of stick together and then bounce off of each other. Price continue to go up from here. Of course, this is just one clue. Don't rely on this too much, because after all, stochastics is still a lagging indicator, okay? Price is the most important thing at the end of the day. Now, the second function of stochastics is that it helps you get out of trades. Like I already showed you one example just now. When the price goes to the other extreme level, you can take profit or scale out. The other way that you can get out of a trade is using divergence, okay? So for example, if you are trading the bearish trend, you got a sell trade right here, and you see stochastic is starting to make higher lows, then this is a warning to you that the trend is going to end, okay? Especially when you see clues like, okay, price making a 90-degree drop, almost a 90-degree drop, and then price cannot break a support level, then from there you better take your profits and exit the trade. And the confirmation that the trend has ended is when the price broke the long-term trend line. Now, just now I showed you a couple of charts which I only put one moving average or two moving average because I don't want to clutter the chart too much. In that way, it's going to be hard to explain to you, okay? But right now, I want you to apply everything that you've learned and then put it all together, okay? So just now was a bullish divergence, okay? And here is a bearish divergence. You can see that we have a bullish trend over here. Price broke the trend line, this trend line. But of course, moving average gave you the signal first. In this case, 50 crossed below 100. And then 5 EMA broke below the trend line, which is a confirmation that the trend has ended. Moreover, stochastics is giving you lower highs. Okay? So if you are in a buy trade, you better get out of this trade, especially when the price breaks below trend line. And a couple of precautions you need to take note of, okay, is it works relatively better when used as a confirmation indicator. Don't just rely on the momentum indicator alone to buy and sell. You gotta combine everything that you have learned together. Okay, and also because stochastics is a lagging indicator, so there will be false signals, especially when you use it in the yen pairs. Okay, and also try not to use it in the super volatile pairs, the exotic pairs, because I personally don't trade exotic pairs. Okay, so with that, I'll talk to you in the next lesson. Bye.